So there are two main lessons from the Great Depression that have been applied this time round. The first is central banks should be aggressive at the time of stress. The Depression was a Great Depression because the Federal Reserve made a series of policy mistakes. This time the Federal Reserve was quite aggressive, but so too has been the ECB and the Bank of England. Second big lesson is there is a role for fiscal policy, and so around the world there's been fiscal expansion. In the 1930s there were a number of fiscal reversals that actually made economic outcomes worse. The monetary policy of the future is not that of our past. I think central banks have understood that they have a balance sheet that they can use to affect financial markets and economic activity. The bad news is in the United States, monetary policy is most likely going to be more politicized. The Federal Reserve is going to be under more oversight, and its actions will be more subject to congressional scrutiny. So a big lesson to learn from the last few years is that the financial system is too complicated and that examiners and regulators just didn't understand financial institutions from the outside. If that's the precedent, then we really shouldn't expect regulation to do much better in the future. The important thing is that regulators put in guardrails, limits on capital and leverage to prevent the really bad outcomes. Now, as for financial institutions, they've got to learn that they're too complicated, that shareholders and creditors couldn't exert a discipline on them, and that managers couldn't run the firms because they didn't know what their risk takers were doing. That's the agency problem, and we have to work on mechanisms, including compensation packages, to make sure they provide more scrutiny in the future. The basic message, at least in the United States, but it's true in most advanced economies, we have too many regulators. In the United States, there are multiple federal agencies, there are state regulators, there are insurance funds, and most of these big institutions have an international footprint. So they worry about regulators in 20, 50, 100 different countries. On top of that, we have a complicated tax system, and accounting rules are very, very intricate. What that means is those institutions have all manners of opportunities for arbitrage, to take advantage of the rules. That's one reason their balance sheet is so complicated. And when an institution gets this complicated, their balance sheet isn't representative of their risk taking, and then they're really hard to monitor. Global imbalances are with us for a long time. Why? Because the economies of the world that are growing the fastest are also those that have the biggest saving rate, mainly China, India, and some of the other countries of the Asian Pacific Rim. As long as they want to manage their exchange rate relative to the dollar, we're going to have big current account deficits and surpluses. We'll have large global imbalances. What that means is, among other things, is it provides more potential for transmission of shocks across countries. What has to happen? Ultimately, we got to bring those economies more into the global trading system. They have to have their own safety net that is stronger so that they don't have to feel obliged to save as much, and that they don't be their own internal source of demand. The big mistake investors made over the last decade is to think that monetary union implied fiscal union. The fact that you issue a security denominated in euro doesn't mean that all of Europe should stand behind it to support it. The fact is, investors called the bluff of authorities, and authorities blinked. And so we have a big bailout package. That's all about buying time for governments to fix their fiscal positions. It's not obvious in all the cases we're talking about that the governments will be able to. The European officials are betting that the Greek political system can hold so that there be a meaningful change in the path for fiscal policy. That's not real evident. Now, if there is some breakdowns in terms of government debt, that doesn't necessarily mean that the euro should be threatened. Monetary union is distinct from fiscal union.